This is Carlos Balta, and I want to welcome you to a presentation of Your Lifestyle Bank. The future starts with you. Live the legacy. At Your Lifestyle Bank, we are unlocking the doors to financial freedom with knowledge, integrity, and the simple application of proven strategies. What I've learned in my 61 years, it's not about how much money you earn. It's about how much money you keep. See, as soon as that plate of money, if that plate of money represented your bank, as soon as that happens, people and entities are there scratching and clawing and taking that money out. The first one, of course, is Uncle Sam. On average, taxes, not just income taxes, but all types of taxes, consume about 36% of every dollar you make. Finance charges, because we finance everything in this country, consume about 34.5% of every dollar you make. That leaves 29.5% of every dollar you make basically to live on. In other words, that's $295 of every $1,000 you make is what you have left over to pay your bills, save for retirement, go on vacations, all of that stuff. Okay. And now, when we start talking about finance charges, people are always concerned about, what interest rate did I get? Well, I'd like to tell people that it's not about the interest rate. Yes, they're important. Yes, that has a factor. But more important than the interest rate is the volume of interest that you're paying. So in this example, let's say that we have a $400,000 mortgage at 4% over 30 years. The payments are $1,909.66. If we take a look at that first year, in that first year, we would have paid $22,915.92. However, of that money, only $6,467.82 went to pay down the principal, the amount that we owed. The rest went to pay interest. So for that year of what we paid in, we actually paid 71.77% of the monies we paid went to interest. Of course, this is on our 4% loan. So it's not really about our interest rate, but about the percentage or the amount of interest, the volume of interest that we're paying. Right. And then we also have to contend with the hidden tax. What's the hidden tax? Inflation. Inflation is a hideous tax because as inflation goes up, our purchasing power goes down. In other words, when we go to the grocery store, we have to put in a lot more money for our basket full of groceries. It just costs us a lot more. You've already been seeing that. Besides that, there are other things. Could this happen to you? Right? Cancer, heart attack, stroke. In other words, could you get ill? Could you get some type of ailment, some type of illness, some type of accident where all of a sudden you can no longer work, you can no longer earn the money that you were making? Is that possible? I want you to know that the number one reason households file for personal bankruptcy is due to medical debt. Right? That's why we say that you need to learn to save and act like a bank. In other words, banks they have a PhD in OPM, other people's money. That's what they do, and they do that so well. So, why a bank? Let's take a look at the traditional bank. The traditional bank works on the fractional reserve banking system. Banks are required to keep on hand a certain amount of cash that depositors give them. Most banks are required to keep 10% of the deposits, and they're referred as reserves. Now, all banks leverage your deposits to make loans. They don't loan with their money. They're really leveraging your money, our money collectively to make those loans. So if we take a look at how a bank makes money, a bank understands that banking is a process, not a product. It solicits deposits and it pays out an interest rate. When I did this slide, it was at 1%. What I need you to understand is the concept more than anything else. All right. So here it takes in all this money, pays out 1%. Right now, it could go to the Federal Reserve, which I would say is up here somewhere, and it can borrow money. It borrows money depending on how much it has in deposits. And so it could actually leverage its deposits 9 to 1. In reality, it's a little bit more, but we'll keep it simple. 9 to 1. What does it do with that? It then takes and turns around, although it used our monies for leverage, it turns around and lends us money again via credit cards at 19%. Again, most of them are a little bit higher now because interest rates have gone up. In this example, if it cost them 1%, and they paid out at 19%, they made 18%. They do the same thing with mortgages, with car loans, okay, with student loans, with commercial loans, with all different types of loans. In this example, they made 28%, right? But that's not true. Why is that not true? Well, because I told you, they get to leverage this 9 to 1. So in essence, they really made 252%. And that's not true either, because credit cards, some student loans, and some of the other loans they do are not simple interest loans or amortized loans. They are compounding loans. In other words, you're paying interest on top of your interest. Now, compounding is a great concept if you're earning it. It's a horrible concept if you're paying it. So let's take a look at the power of compounding over time. Assume for a second that you had $1 that doubled every year for 20 years. So it's 100% yield every year for 20 years. No, I don't know someplace where you can put your money there it's going to double every year consistently for 20 years. It doesn't exist. What I want to show you is two things. One, the power of compounding over time, and then what happens when you interrupt the compounding. So take a look here. $1 where you were getting 100% yield that compounded year after year after year after year. In year one, you had $1 and you wind up with $1,048,000. Now, if you introduce interruption, if you interrupt this compounding, let's say with taxes, right? Let's say that you get taxed at 17%. You get taxed on your growth year after year after year at 17%. Well, look, you no longer had $1 million. Now it's $177,000. And if this went to 27% that you were taxed on, all of a sudden, now it's down to $57,666. And what happened to the power of compounding? You destroyed it by interrupting it with paying taxes. Now, don't take my word on this. Albert Einstein said it best. Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Okay? Now, most of you don't know, but the number one asset for all major banks, and I say most of you don't know because I didn't know this either until I learned it. The number one asset for almost all major banks, what is it? It's bank-owned life insurance, BOLI. As a matter of fact, Bank of America has over $24.7 billion of their Tier 1 capital in BOLI. Why would they do that? Because those cash values are liquid. They show as assets on their balance sheets, and they grow tax-deferred at guaranteed rates. We'll show you how you can do the same thing, and instead of tax-deferred, how we can make it tax-free. Nevertheless, it's not just Bank of America. Most of the major banks are doing the same thing. And it's not just banks, okay? Almost every Fortune 500 company has something called COLI. And what is that? Corporate-owned life insurance. This is insurance that they buy on the executives of their companies. Now, Warren Buffett says, if poor people would just do what rich people do, they wouldn't be poor anymore. That's a very true statement. The problem is most people don't know what that is. And that's why we're here to teach. Okay. The first thing we're going to talk about is your lifestyle bank. Now that's powered by IBC. IBC stands for the Infinite Banking Concept. Infinite Banking Concept. It's based on this book, Becoming Your Own Banker, by a man named R. Nelson Nash. May he rest in peace. Now, Mr. Nash did not invent this strategy. He did not invent it. He just found it. He discovered it. And then he labeled it the Infinite Banking Concept. Yeah, it's his label. It's his name. But the strategy isn't his. This strategy has been employed for well over 100 years, as long as insurance has existed. In his book, he talks about several things. One is the rapid elimination of outside debt. You saw how much you were paying on average for debt. We need to get rid of that. 2 is you want to get to the point where you are financing everything you purchase from your bank. You're financing everything you purchase from yourself. 3, we want to grow your income and wealth in a tax-free environment for you and for your heirs. He also talks a lot about not stealing the peas. And what he means by that, without getting into the story behind why peas, what he means by that is simple. If you're financing it from your own bank, you don't have to pay yourself back. If you finance it from Wells Fargo or Bank of America or Chase or a credit union, you have to pay it back. But here you don't have to pay it back. But what you need to understand is if you don't pay it back, you are stealing from yourself. So you need to treat yourself and treat your bank the way that you would treat any other bank. The 5th point on here is that once you understand this, it becomes almost a moral imperative that you teach your family and friends the same thing. So here you are. I want you to know that we are authorized practitioners of the infinite banking concepts. Okay, how can you do this? It's simple. Create a lifestyle banking system using properly structured whole life insurance and pay yourself instead of the traditional bank. Now, when I talk about properly structured whole life insurance, what is that? Well, first, it has to be from a mutual company. It has to be from a mutual company. There are mutual companies and stock companies. A stock company is owned by the stockholders. A mutual insurance company is owned by the policyholders. So you're going to get it from a mutual company. You're going to get a 3% guaranteed interest rate on your cash value. So whatever you have in your policy, you're going to get 3% interest rate. But it's not just 3% simple interest rate, it's 3% compounding interest. Okay? Since it's a mutual company and the policy owners own it, it's going to pay dividends. Dividends are the excess premiums. In insurance, that really means their profits. So you're going to get a portion of the profits paid out to you because you own the company. Okay? You're going to get guaranteed policy loans from the insurance company. In other words, we're never going to touch the monies that you have here. They're going to sit there, compounding forever and ever. Amen. We do not want to interrupt it. Remember what I said about interrupting compounding. So how are we going to be able to use these monies? Simple. You're going to go to the insurance company and say, hey, I've got this money sitting in here. I want you to loan it to me. Okay? I don't want to withdraw it. I want you to loan it to me. And the insurance company says, okay, I will. You don't have to worry about, an application. You don't have to worry about your credit score, your debt to income ratio. None of that matters. The only thing that matters is that the money is there. If the money is there, you tell them, hey, send it to me as a loan. And they send it to you as a loan. They're giving you 3% compounding interest, plus it's helping to accrue dividends, and they're going to charge you 4.65%. I'll show you how you'll always be upside right in that transaction so long as you pay yourself back at least the interest, and hopefully you start paying yourself back the loan the way you would with any loan that you take now. You're going to have access to tax-free income when it's time to start doing that. And there's a death benefit so you can pass on a legacy to your loved ones. So, besides that, remember when I asked you if these things could happen to you? That's why we also have lifestyle protection. Lifestyle protection is simply living benefits. Living benefits. What does that mean? That means that you have access up to $1 million if you have a terminal illness, a chronic illness, a critical illness, critical accident, or disability. And the beauty of it is it's tax-free. It's tax-free. So let's talk a little bit about life insurance policies. There's a few things you need to know. Every policy has two people. It has the owner and the insured. Is it possible to be the owner and the insured? Yes, but the owner has to have what's called insurable interest on the insured. Insurable interest. What does that mean? That means that there is a financial interest. Right? So when I said you can be the owner and the insured, here you are in the mirror. Do you have a financial interest in yourself? Well, of course you do. Do you have a financial interest in your spouse or in your children? Of course you do. You might even have one in your parents. But guess what? If you're a corporation or a bank, you have one in your executives, don't you? Of course you do. What you have to understand is that the owner of the policy is the one that controls the cash value. It is the owner's policy. The insured is just the insured. It is the life that they're basing this policy on. That's all it is. That's why banks and corporations can do this, because even if their executives leave their organizations, the bank or the corporation still owns it and still controls it. A concept that's very important to understanding why we do what we do is the fact, and it is a fact, that everything you buy, you are either borrow and pay interest on, or you pay cash and give up interest. Again, you either borrow and pay interest, or you pay cash and give up interest. Right? So now let's assume that you're going to go out and buy a car. Right? You're going to get a car, and that car costs $25,000. And you're able to go to, I don't care, Bank of America, Wells Fargo, your local credit union, wherever you bank, and get a simple interest loan. Not an amortized loan or anything else, but a simple interest loan for the purchase of that car at $25,000. You get one at 4.65% annual interest rate, simple interest, over 60 months. Your payments are $467.78. So if you were to take those payments of $467.80, you multiply it by the 60 months that you're paying for this, you wind up paying back to the bank $28,066.80. In other words, this loan cost you $3,066.80. Now, if you would have had those $25,000 in your lifestyle bank, and they would have grown compounding at 3% interest over those 60 months, your cash value would have turned into $28,652. In other words, you would have made, or your cash value would have appreciated $3,652. Yes, Carlos, but I wanted the car. Excellent. You would have gone to the insurance company and said, insurance company, give me a loan. And the insurance company gives you a loan for the $25,000. They're going to charge you 4.65%. We already know that the cost over that, because you paid them just the way that you would have the bank, the cost of that was $3,066. If you subtract the cost of $3,066 from the $3,652 that you made, you wind up with $585 profit. In other words, you were upside right $585. The question to really ask is, do you rather lose $3,066 or be upside right $585? Obviously be upside right. But some people say, Carlos, I hate all this financing stuff. That's why I pay cash. Well, if you pay cash, you take your cash, you go down to the dealership, and you plunk down your cash for that $25,000 car. At the end, what do you get? You get a car, but what happened to your cash? It just went up in smoke. You just burnt right through it, didn't you? 5 years later, what do you have to show for that? Well, you've got a car, and it's worth something. I don't know what. And you have a pile of ash where your money used to be. Had you financed it from yourself, okay, your monies would have grown to $28,652. Yes, you would have had expenses in the interest rates, but you still would have been upside right, $585. But the most important part is this. You'd still have $28,652 sitting in your bank earning compounding interest plus what? Accruing dividends. Oh yeah, you still have that car worth whatever it's worth. So how do you make money with your lifestyle bank? Again, you have to remember that banking is a process, not a product. Now you're the bank, so you're going to make your deposits, which we call premiums, into your lifestyle bank. This is not your grandfather's whole life policy. This is a properly structured one, where you will see cash values immediately instead of waiting a year, 2 or 3 years down the road. It's the way that we do things. You'll understand in just a little bit. So now you're using the monies that you have in your cash value. You're never going to touch them, but you're going to go over to the insurance company and say, hey, give me a loan. With that, you're going to pay off your credit cards. With that, you're going to pay down your mortgage. With that, you're going to pay down your car. or your student loans. You're going to pay these things, right, and pay yourself back. Why? Because we want you earning the interest. We want you earning the interest. Now, sometimes they say, Carlos, but I don't have enough money to deposit in here to be able to pay these things. That's okay. Some people do, some people don't. It doesn't matter where you start. All that matters is that you start. We'll draw up a plan to best get you where you need to be. Now, remember, it's not just about the things that you already have financed or the things that you may want to finance. It's also the things that you pay cash for. You want to go on that vacation? Don't pay cash. Finance it from yourself. You have a side business, all of a sudden you owe Uncle Sam more money than you thought you were going to owe him. Whatever you do, don't finance it through him. He really is a crook. Finance it from yourself. It's time for you to invest in real estate or whatever other investment you want to invest in. Have the monies touch your bank first, then borrow from it and go out and do this. Why? Because the more you put in here, the more this is going to accumulate at 3% compounding interest, plus the larger your cash value, the more dividends you're going to be making. We want you earning the compounding interest. Now, not all policies are created equally. What do I mean by that? In a traditional policy, if this pie represents the premium and that premium were $100, it would buy X amount of death benefit depending on your age, sex, and health status, right? From there, eventually, you have cash accumulation. You're not going to have on any whole life policy, traditional whole life policy, cash accumulation in the first year. It's just not going to happen. On the good policies, you'll see it in the second year. I've seen policies that take 3, sometimes 4 years to generate cash. Why? Because the expenses that the company goes through to put this policy in place is larger than the amount of premiums that you're putting in that first year. Consequently, there can't be any cash accumulation for you. Fine. So how do we do things? What is properly structured for the infinite banking concept? Properly structured simply means that instead of taking, if this pie again represents $100, instead of taking the $100 to buy death benefit, we're only taking 30 to 40% to buy death benefit. Okay? The other 60 to 70% or $60 to $70 is coming right in here into cash accumulation. Cash accumulation. Now, since we're overfunding this and we're putting monies in here because that money is now protected, nobody can touch it. You get sued, sorry, they can't touch the monies you have in your policies. Not even the IRS can touch the monies that you have in your policies. So now we have all of this monies in here that's growing at 3% compounding interest, right, and helping to accrue the dividends, and it's protected. In order to do that, though, we have to have enough of a death benefit. Otherwise, this becomes something called a modified endowment contract, a MEC. And we void all those beautiful protections I just told you about. So we don't want to do that. In order not to do that, we combine a whole life policy, and embedded in the whole life policy, we have what? We have a term policy. That gives us the death benefit needed so that we can overfund this policy, right? So let me ask you a question. Which would you rather have? A policy where we're able to overfund and you're getting cash value immediately, or one that's going to require 2, 3, or 4 years for you to have any cash accumulation? Evidently, this one. Let's continue. If this were a perfect world, this would be the cash flow. You would take all of your income, and deposit it in your bank. Now, some of it would hit the outside wall. There's some costs, the cost of insurance, et cetera, et cetera, et cetera. But the great bulk of it would go straight into the bank, into that vault, where it's earning 3% compounding interest plus helping to accrue dividends. From there, you take out loans to pay your bills. You take out loans to do your investments. You take the proceeds of your investment and you would pay yourself back. That's in a perfect world. But ladies and gentlemen, we do not live in a perfect world. We do not live in a perfect world. Consequently, what we do is take a look at what your cash flow is and take a look at what your free cash flow is, and then take a percentage of that to start doing your bank. Now, there's another way though. If you own a house, and again, these are two separate things. We do your lifestyle bank every single day for people. for some people, under the right circumstances, we combine your lifestyle bank and first lien HELOC. Okay? And so now what we're going to do is the power of leverage. This truly is using other people's monies. You'll see. Okay? And so what the object is to be debt-free in 7 to 10 years on average. Debt-free. That includes your house. Okay? The value of your house now becomes 100% equity because you'll owe nothing on it. Okay? We're going to max fund your lifestyle bank. We're going to max fund your lifestyle bank. What does that mean? Well, you remember in that circle I told you we could take $70 of that $100 and put it into overfunding. In reality, the way that we do things, you can actually double that 70 and go to $140 and 30. So $30, $30 to $40 are going to buy death benefit, right? And you can put in $60 to $70 straight into the cash. Well, you can double those 60 to 70. So you can put in $120 to $140 straight into cash. That's what we mean by max funding. Okay? And we can usually do it at a much higher level than we would have without the HELOC. So let's take a look at what that first lien HELOC means. A HELOC traditionally is a second mortgage. It's a second mortgage, right? It stands for Home Equity Line of Credit. HELOC, Home Equity Line of Credit. And so traditionally it's a second mortgage. With first lien HELOC, it's not a second mortgage. So what happens is you come in, you get this first lien HELOC, they take a look at the valuation of your house, they're going to loan you 90% of the value of your house, and they're going to come in here at closing, they're going to pay off your mortgage. And then whatever you have left over is available to you for you to use whenever you want to use it. Now, when we talk about this, there's a difference between a traditional mortgage and a first lien HELOC. So let's take a look at that real quick. We're going to look at money flow and we're going to look at interest calculations. Money flow. A traditional mortgage is a closed-end loan. Closed-end loan. What does that mean? They gave you the money when you took out the mortgage, whatever you used it for, typically to buy the house. They gave you that money, right? You bought the house. Excellent. Now, once you start making payments, let's say your payments were $1,000, that's it. The money goes from you to them. You can't get that back. You can't go to them and say, hey, I need 500 of those $1,000. Give them back to me. That won't happen. You can't access it. However, a HELOC, a home equity line of credit, is a line of credit. It's kind of like a credit card. You know how you charge on your credit card, then you pay it off and you can charge on it again? Well, it's the same thing. It's an open-ended loan. It's an open-ended loan. So in that example I just gave you, you just gave them $1,000 and you turn around and say, hey, I want $500 back. You just take them. You literally take them. And when I say you just take them, it's because this comes with its own bank account, a fully functioning bank account, fully functioning. Checks, debit card, online banking. It's a fully functioning bank account. And that's important, and I'll explain why in a moment. Let's take a look at the interest calculations. A mortgage is an amortized loan. And so right at the very beginning, they'll give you an amortization schedule. You'll see that you're paying interest on the principal every month. It's calculated monthly. And you know exactly what it is. Most of the interest, because of the way these things work, are paid up in the first few years, right? As you go further into your loan, now you'll start seeing that you're paying more principal than interest. But at the beginning, as I showed you, remember that 71.77%, it's all about the interest. When we take a look at first lien HELOC, it's not a monthly calculation, it's a daily calculation. It gets charged once a month, but it's a daily calculation. And since it's a bank account, monies come in, monies go out. So every day that you have a balance that's lower is a day that you're paying less interest on. We'll explain that more in a moment. So right now, how do you pay your bills? Right? How do you pay your internet bill? How do you pay your credit card bill? How do you pay your electric bill? Well, you're either going to do online banking or you're going to write a check. Although we rarely write checks anymore. With first lien HELOC, you do the same thing. Okay? If you go out to dinner, how do you pay for dinner? Well, you either go to an ATM and get cash, which Rarely we do. Or you usually use a debit card or a credit card. With a first lien HELOC, you're going to do the exact same thing. The exact same thing. All right? So let's take a look at an example. Let's say that we have Johnny, and Johnny has a house that's worth $500,000. Okay? And he gets a first lien HELOC. And when he got his first lien HELOC, they gave him a line of credit of $450,000. Now, he owed $100,000. He owed $100,000. So when closing came, they paid the $100,000. Even though he has a $450,000 line of credit, he paid $100,000. So here, his principal balance is now $100,000. Okay? But Johnny makes $10,000 net a month. So he's going to deposit this into that checking account that I told you about. He makes his deposits. It's in the checking account. Great. What happens is there is something called the sweep. It sweeps in and sweeps out. That'll become clear in a moment. So now there's $10,000 in the checking account. In that evening, the money is swept out of the checking account and turns around and it pays down the principal balance. So now the new principal balance is $90,000. Okay? Yeah, Carlos, but if he did that, now he's got no monies to live on. Well, Johnny's got about $7,000 in monthly expenses. So what happens is throughout the month, he takes and he pays his expenses. So he has $7,000 in living expenses. Now, even though his checking account was at zero, he could actually write a check for up to, when the balance was 90, if his line of credit's 450, he could write a check for up to $360,000. He doesn't need that money. He needs $7,000. So he pays the $7,000. He pays the $7,000, and lo and behold, now his new principal is $97,000. So now that new principal balance is $97,000. And so notice it's $3,000 less than when you started. And so this is going to repeat every month. That will repeat every month. So if we take a look at the cash flow for Your Lifestyle Bank and the first lien HELOC, this is the way it is. We get the HELOC. It pays off your mortgage. We also go ahead and take a look at any debt you may have and go ahead and take care of that. Let's pay that off. Okay, from there, we're going to max fund Your Lifestyle Bank. From there, we're going to take loans from Your Lifestyle Bank to do what? To pay down the HELOC. Okay, and then we're going to take your income, we're going to put it into the HELOC, and from there, we're going to take out monies to pay your living expenses. So here is a case study, a real life case study. In this case study, it's a couple. They're 35 years old. Now, their net monthly income is $10,350. Their house, the market value of their house is $525,000. Okay, they have a $400,000 mortgage, 30 years at 4%. Okay, their monthly interest and principal, not taxes and insurance, but interest and principal is $3,010.70. Their household expenses are $4,000. Okay, and that includes your living expenses for foods, utility, phones, etc., which is $3,205. Credit cards are paying $310 on $12,000 in debt, and a car payment where they're paying $485 on $19,000 in debt. So they have a free cash flow of $3,339.30. That's what they are. That's where they are right now. Okay, or that's where they were. So then we went and we got a properly structured whole life insurance policy form. In that, it's a whole life policy where they're going to pay just for 10 years, and the whole life has a death benefit of $808,305. That has a premium of $988.65. We've also embedded a $600,000 term, and that has a cost of $11.35. Now, we did this policy on her. Why? Because the cost of insurance was less. So this is about her. We can do it on her. We can do it on him. We can split it up and do partially on him and partially on her. In this particular case, they had other insurance. So the best way that we could do this was on her life because the cost of insurance was less. Nevertheless, This comes out to $1,000 a month. All right. Now, the savings account, the overfunding part, which we're also only going to fund for 10 years, is $46,000 a year. That is the max we can do for this policy. This is a policy that we've done because they have the HELOC in place. This is a policy that they could not afford to do if they did not have that in place. It would have to be smaller. Very good. So now we're going to be using other people's monies. What happened with this? First, let's take a look at the comparison in the HELOC versus their current mortgage. Here, their current mortgage, $400,000 at 4% over 30 years. Their payments were $3,010.70. With us, notice that the principal balance is $433,000. Well, why is it more than their current mortgage? Because we went ahead and we covered the closing costs associated plus the debt that they had, the car payment and the credit cards. Okay, so let's take a look at what happens when we compare both. So here in the traditional mortgage, okay, the total number of payments is $687,000. What that means is that they paid $287,000 in interest over the course of those 30 years. Over here, they paid $575,000, and it took them 10 years instead of 30 years. All right? What that means is that they paid in interest $142,897, and they finished this again in 10 years. Not only did they do this, but they also max funded their insurance policy, max funded their lifestyle bank, and we saved them $144,580 in interest. Now, continue. Let's take a look at the summary at year 10. Your lifestyle bank that has a cash value of $626,000. Don't get too excited. We have some loans against that. So the equity, once we take out the cash value that we have and we subtract what we owe in loans, there's $99,000 in equity in their lifestyle bank at the moment at year 10. Okay? Should something happen to her, there's $2.5 million that gets transferred to the family. Now, the house, even if it did not appreciate in value, and it's still worth only $525,000, the thing is that the entire $525,000 is now equity. The entire amount is now equity. Okay? So their total equity between their insurance policy and the house is $624,146. That's at year 10. Well, what happens at year 20? At year 20, the cash value is now up to $1 million. By the way, I want you to know that we are no longer paying any premiums into the policy. We're continuing to pay down some of the loans, but we're not paying any premiums. And when we do that, the cash flow that they had has increased. In other words, we're not having as much of a cost as they did prior to starting all this. So they have a larger free cash flow. But nevertheless, what's happened is now the equity that they have in their policies at $754,000. Okay. The wealth transfer, should she pass away, is $2.1 million. The house, even if it didn't appreciate in 20 years and it's still worth only $525,000, is free and clear. So the entire equity is theirs. So that means that their equity is now at $1.2 million. We accomplished all of this by using other people's monies and having a cash flow that was better than the cash flow that they had when they started this process. See, the problem in America isn't so much what people don't know. It's what people think they know that just ain't so, according to Will Rogers. Okay? So I say, don't do what the banks say, do what they do. Be the banker. Okay? The next steps is to go ahead and schedule a Your Lifestyle Assessment session with me. You can do that. Okay, well, first of all, what is a lifestyle assessment session? It's simple. That's where I'm going to ask you getting to know you questions. I want to find out what your financial goals are. Okay? We're going to ask questions about your income so we can create an enhancement plan. Questions about your loans so we can do a payoff plans. Your current credit card so we can do a debt elimination plan. Your current savings/investment so we can do an expansion plan. We're going to do that because I'm going to need you to, when we do that, I'm going to need you to have all this information available for us. Income, all your sources of income. all your loans, the payment, the balance, the interest rates. Same for the credit cards. Your saving and investment vehicles. If you have a bank account, 401k, IRA, stocks, bonds, crypto, what are you saving and investing your monies in right now? Okay? Why? Because it's time to plan. Okay? This is how you get in touch with me. Plain and simply, this is how you get in touch with me. That's my cell number. This is one of my email addresses, carlos@boutthestone.com. You can come over here to this, excuse me, to this tiny URL and do that, or just simply take your phone and go ahead and scan that. When you do that, either come here or scan this, you're going to be taken to this form. When you fill out the form, this will pop up and it'll give you a link to my Calendly. Just go ahead and click on that and you will be scheduled in my calendar directly. You'll be scheduled in my calendar directly. So this is the end of our presentation. It's your lifestyle bank where we envision, we enhance, and we protect.